you've heard it said that Alan Greenspan is the most powerful man in the economy. What does that mean? How does the Federal Reserve exercise its power? To understand the way the Fed works, we have to begin by looking at the way banks work. Banks attract money from customers by offering them the convenience of easy withdrawal. That is, you put money into a bank, into a checking account, so that you can spend it when you go shopping. Now, checking accounts are important, and the Fed keeps tally on how many checking accounts are out there and how much money is in them, because this is an important part of the money supply. If you take checking accounts and you add them to the currency that's in circulation, you've got the money supply, M1. And the Fed watches that money supply, because if it gets too big, we could have inflation. If it gets too small, we might wind up with a recession. Again, people put their money into checking accounts because they like the convenience of taking it out when they want to write a check. But banks can attract money through other sources as well. They can offer savings deposits. They can offer you a certificate of deposit. They can offer you other accounts that pay higher rates of interest, because in order to get you to put money into one of these accounts, you've got to give up the convenience of being able to take it out exactly when you want to. Now, think about the way a bank makes a loan. When the bank makes a loan, which becomes an asset of the bank lends you money by giving you a checking account. You walk in, you say, I want to borrow money to build a house, and the bank doesn't just hand you a sack full of cash. They give you a checking account, and you can write checks out of that account. So when the bank makes a loan, they are creating checking accounts out of thin air. And banks might be tempted to create a whole lot of checking accounts because that's profitable. When you create one, you also get a loan, and that loan earns the bank interest. Well, here's the way the Fed keeps this process under control. If you're a bank, you can only create a certain number of checking accounts. And this ratio of checking accounts to your reserves is called the reserve requirement ratio, or the required reserve ratio. Now, what's a reserve, you might ask? A reserve is either cash that a bank keeps in its vault, or bank reserves that are on deposit at the Federal Reserve. The Federal Reserve Bank is the banker's bank, and when a bank makes a deposit at the Fed, that's called a reserve deposit. So by law, the bank has to maintain a ratio of cash in the vault and deposits at the Fed, that is, legal reserves. They have to keep a ratio of reserves to checking accounts of no more than 10%. That is, for every dollar you issue as a bank in checking liabilities, you've got to have 10 cents either in cash in your vault or on deposit at the Fed. Now, this then puts a constraint on banks. If banks want to offer more checking accounts, if they want to create more loans, if banks want to make more money, they've got to have reserves to do it. And this is where the Fed gets its power, because the Fed has the ability to control reserves. There are two things the Fed does. First of all, the Fed prints currency and can put it into circulation by buying and selling things. The next thing is, the Fed, being the banker's bank, can influence how many reserve accounts banks have to hold or are able to hold. Let's see how this works as we look at three policy tools of the Federal Reserve System. The three policy tools, the three ways that the Fed can influence the money supply, are changing the reserve requirement, changing the discount rate, and finally, changing the amount of reserves available for business through open market operations. First, changing the reserve requirement. Suppose the bank says that instead of having to hold 10 cents in reserves for every dollar in checking, you only have to hold 5 cents in reserves. Well, suddenly, banks have got too much reserves. That is, they have excess reserves. And what banks will do in their pursuit of profit is immediately create more loans and create more checking accounts until the ratio comes to the legal requirement. So banks could almost double their checking accounts with their given reserves if the reserve requirement is cut in half. So when the Fed tells banks that it doesn't have to hold as many reserves, banks are free to make more loans and create more checking accounts, and that increases the money supply. If the Fed increases the reserve requirement, then banks have to call in loans and destroy checking accounts and shrink the money supply. Now, the second tool that the Fed has available to it is changes in the discount rate. And the discount rate influences the likelihood that a bank will borrow from the Fed. The discount rate is the rate that the Fed charges insured depository intermediaries, that is all depositories like banks, savings and loans, credit unions that have federal deposit insurance from the government. If you've got that insurance, then you can borrow money from the Fed. And the Fed charges you a very low interest rate, much lower than you could get if you went to the open market. But borrowing from the Fed is kind of like borrowing from your parents. You usually get a good deal on the interest rate, but you've got to answer a lot of nosy questions. Well, why do you need this money? And the next thing you know, the Fed is in your bank doing an audit. So banks tend not to borrow from the Fed if they can help it. And although this was the most important tool that the Fed used in its early days, nowadays it's relatively unimportant for the Fed's influencing the money supply. The third tool that the Fed uses is called open market operations. And open market operations influence the amount of reserves out there in the banking system directly. That is, the Fed buys and sells Treasury securities on the open market. Now think about this. If the Fed writes you a check for a Treasury bill, say you're selling a Treasury bill to the Fed writes you a check, you take that check to your bank and deposit it. The bank then presents the check to the Fed for payment, and the Fed can either give the bank cash or it can give the bank credit in its reserve account. Either way, your bank just wound up with more reserves, which gives it more room to create more checking accounts, and the money supply expands. So these are the three policy tools of the Fed: change the reserve requirement, make discount loans to banks, or open market operations. Now, open market operations are by far the most commonly used Federal Reserve policy tool. The Fed does open market operations every business day, increasing or decreasing the amount of bank reserves in pursuit of its policy goals. The reserve requirement is the least frequently used tool because it's the most powerful. Using the reserve requirement to try to fine-tune the economy is kind of like swatting a gnat with a sledgehammer. The reserve requirement has huge, far-reaching consequences. It has a kind of multiplier logic to it, and therefore any small change here can result in a big change in the money supply that's not easy to control. The Fed is most likely to change the reserve requirement during a period of rapid inflation or very deep recession. Finally, we've already talked about the discount rate. Banks borrow and lend with the Fed all the time, but less and less do banks borrow from the Fed if they can help it, because there are alternatives. They can borrow from each other, they can cash in their own securities on the open market. They just don't want to have to deal with the Fed's scrutiny. So more and more, the banks that actually borrow from the Fed are banks that are in trouble and can't get funds anywhere else. So it's a kind of emergency loan that usually involves a lot of scrutiny from the Fed itself. Right, so how do these tools work? Let's go back now and look at our map of the money market. Here's our map of the money market, the quantity of money and the price of money, which is the interest rate. The demand for money is represented on the red curve, and the blue curve shows us the Fed's supply of money that the Fed has determined in the market. If the Fed increases the money supply, then at the old interest rate, we're going to have an excess supply of money, and the interest rate will be bid down as people try to buy bonds with all this extra cash that the Fed has pumped into the system. As the price of bonds is bid up, the interest rate is going to fall. And as the interest rate falls, people decide that they're content to hold a larger fraction of their wealth in the form of cash. That is, as the interest rate falls, the quantity of money demanded increases. Well, how does the money supply actually in practice increase? It increases by one of three ways. First, the Fed lowers the reserve requirement. If it does that, banks can make more loans and create more checking accounts. The second thing would be banks borrow from the Fed. If the Fed makes the terms of borrowing easier, banks will borrow more. And when they borrow more, they have more reserves, and they can create more loans and more checking accounts. And finally, third, open market operations. Whenever people sell securities to the Fed gives people cash or checks, which they put in their banks, and when the banks present them for clearing with the Fed gives the banks reserves, which then gives the banks more room to create more loans and checking accounts. The Fed has the banking system on a leash, and think of the banking system as a hungry dog that's trying to get over there to get that big piece of red meat. What the Fed does is give the dog more leash by creating more reserves. And whenever the Fed creates more leash for the dog goes right for the meat. The banking system is going to expand to create as much money, as much checking accounts, as many loans as the Federal Reserve System will allow. That's how the Fed controls the money supply.